Hello, good morning, everybody. Welcome along to today's Growth Hub webinar. I am once again joined by Joe Tomlinson today, who's from BusinessWorks. Today's session is part of our Business Essentials webinar pack, and today's session is all about VAT. And Joe's going to tell us everything you need to know about VAT. Just a few quick words from me while people are still joining. As with all the other webinars we've done in this series, this one is being recorded and will go up on the Growth Hub website. As you've already registered, because you're here today, you'll get an email from me with a link to the slide deck, the written resource that Joe's done to go along with this, and the recording. So don't worry if you miss anything. Don't worry if you need to drop off halfway through or anything like that. The recording will come out to you. That said, I hope you can all stick around till the end, and it'd be really great to see cameras on, because it's always nice for the presenter, Joe in this case, to be able to see some lovely smiling faces. Similarly, if you want to say hello in the chat, say who you are, say a little bit about your business, that's always really helpful. And we've got some time for a Q&A at the end, and we usually turn the recording off for that. So feel free to stick questions in the chat box as you go along. If it's relevant to the section we're at, I'll happy to read that out for you, or we'll have time for a bit more of a free-flowing Q&A at the end. Joe's also got some funded one-to-one slots from us. So if there's anything that comes up and you're like, I would really love to have 2 hours with Joe to talk about this specific thing on my specific business, that is available to you. For that, let me know in the chat. Do keep an eye on the chat box throughout, because I'll be putting some useful links in, answering your questions. So keep an eye on that as we go. And as I say hello to the other businesses, because it's a good way to meet people and advertise your business, let people know what you are all about. I think that's about everything from me. As I say, if you need any support, have a look in the chat box. There are links, emails, or I am available throughout. So just let me know how you're doing. Joe, over to you then.
Thank you. Here we are again. First, I've seen some familiar names there and familiar faces. So here we are again. My name's Joe Tomlinson. Today we're going to be talking about VAT under this Business Essentials group of webinars that we've been looking at. So just a quick recap on who I am. So I spent 20 years in industry supporting big blue chip businesses in how to make good commercial decisions. That was mostly manufacturing, mostly food manufacturing, mostly chocolate, the likes of Cadbury's, Bird's Eye, Ferrero, Thornton's, Park Cakes, all sorts of different food-based businesses. Anyway, then after being made redundant 3 times, I decided to start up my own business. I'd never been in an accounting practice, so I had a blank sheet of paper and sat down and thought, what kind of things do I know that businesses might find useful, small to medium-sized businesses might find useful? So along with doing tax returns, which my wonderful team of 12 do fantastically well at, we also do something that I call wraparound care, supporting our businesses when they're growing, when they're making business decisions, when they're buying, when they're selling, all sorts of other things. And I'll support them when they're going through those kinds of things, using a lot of the experience that I got when I was working in industry for those 20 years. I'm also, I have an economics degree as well as an accounting qualification. So I'm able to help people with lots of different kinds of business decisions, but also help people to understand their numbers and make, therefore, good, eyes wide open decisions based on those numbers. So let's get on to the exciting topic of VAT. VAT is the most complicated, in a lot of ways, tax that we have in the UK, and the UK has the most complicated tax system in the world. So we've got some crazy rules going on within VAT, and it is always good to check the detail on whatever it is that you're doing, because the devil is in the detail. So what we're going to talk about today, we're going to talk about when you must register. So under the legislation, there are rules around when you have to register, whether you want to or not. But for some people, they will make a decision to voluntarily register. And why would you do that? And then if for either the first or second reason you decided you were going to go through registration, how do you go about doing it? Can you claim any pre-registration expenses on your first VAT return, and what are they? What kinds of schemes are there within VAT? A lot of people have got a misconception that there is just one VAT regime and everybody follows it, and that's not true. I'll talk to you about what the options are that you've got, when and if you should deregister for VAT, and then we'll have a quick look at some rules and rates. Now, it is very much a high level look at rules and rates because we could talk for a year and still not have talked about all the different complexities of VAT. We have been reading about giant marshmallows this week and the VAT case that's going through the appeal courts about whether or not you should charge VAT on a giant marshmallow. I mean, it is literally down to that level. How big is a marshmallow affects whether or not you charge VAT on it. It is a crazy system and it's one that we all have to live with. So let's just talk about some of the general rules under there. And then just a mention of making tax digital for VAT at the back end of the webinar. So VAT registration. So you must compulsorily register for VAT if your turnover of taxable supplies breaches £90,000. Now, I think a lot of people, most people, I think are aware of that. They're aware of the 90,000. That 90,000 often appears in the budget, you know, and sometimes we'll watch the budget or read the information following on from budget. It sits as headline news quite regularly in a lot of places. So the 90,000 isn't new news. But what could be new news is what it really means. So there is no such thing as a VAT year. The 90,000 year, the year that applies for the 90,000 is the last rolling 12 months. It's the last rolling, actually, in a lot of ways, 365 days. So if you are deciding that you're not going to register for VAT until you really have to, and your turnover's creeping up, you know, you've started trading, it's a relatively new business, and you're going to register for VAT as and when you have to, you should be monitoring your turnover of taxable supplies, of things that you're selling that are within the VAT regime, because you need to check that last rolling 12 months. There's also a next 30-day rule. And I'll talk to you about that as well. But do keep an eye on that. Now, if you have software and your sales are in your software, then lots of software has got reporting functionality that allows you then to each month, if you're doing kind of small sales, gradual increases towards that 90,000, if it's a retail establishment, a cafe, a bar, or something like that, you could then have a look each month at where you were for the last rolling 12 months or since you started trading, using the reports in whatever software it is that you've got. But I would definitely recommend that you do that and monitor it. So the first example is, let's say it's a cafe. So it's a cafe, and that cafe is increasing their total sales in the rolling 12 months each month that they're open. And they're jollying along and they're doing, I don't know, £10,000 a month in sales and along the go. And at the end of the July, the turnover for the previous 12 months or since they started has now breached the 90,000 for the first time. So they now have 30 days in which to register for VAT. So if you check your turnover on the reports that you're getting from whatever software you're using, and in that report it says you're at 92,000 up to the end of July, you have until the end of August to register for VAT. And the effective date of registration would be the 1st of September. So you kind of get an extra month So you've breached, but you've been given that 30 days to register. Therefore, you've kind of been given an extra month that you weren't registered for VAT. So that's the way that that works if your turnover is creeping up. But what about if you do things and you're tendering for big pieces of work, and you tendered for a big piece of work, a big contract, and it was worth £100,000, and you found out on the 1st of May that you had got that contract, and you were going to deliver that contract during May, and it would be payable at the end of May. Now, you don't get any kind of leeway because you only found out about the contract at the beginning of May, and your effective date of registration is the same day. It's the beginning of May. So it's the date that you became aware that you would breach the threshold in the next 30 days. That's that rule. So when you go online and register for VAT, they will ask you what date you want to register from. And you need to be mindful of these rules so that you put in the correct date for doing that. The other thing that you need to be mindful of is if you did, in fact, win this contract that you'd tendered for, you found out on the 1st of May, you delivered it during May, you're going to be raising an invoice, well, as soon as possible. If you've been on any of my other webinars, get that invoice out there as soon as you possibly can. Because the quicker you get it out there, the quicker you're going to get paid. But we don't have a VAT number yet. So if we're saying that from that 1st of May, we're now VAT registered, and that big contract worth £100,000, we now need to invoice £120,000, we can't put a VAT number on that sales invoice until we've got one. I mean, that sounds really obvious, but you'd be surprised how many new clients we get who are in the process of registering for VAT or know they need to register for VAT, and they're charging VAT, but they don't have a VAT number. You can't. So how do you go about doing that? You would need to speak to this customer and say to them, I'm in the process of registering for VAT. I would suggest you put an invoice on for £120,000 and then tell them that as soon as the VAT number appears, you will give them an amended invoice for that to reflect the VAT. If they don't like that idea, you can raise an invoice on them for £100,000. And then once you've got the VAT registration number, you can raise a VAT only invoice for the 20,000 with that VAT number on. So speak to your customers if you're in that situation and find out which way they would prefer you to do it. So one of the things I mentioned when I was talking about whether or not you needed to register for VAT was I mentioned taxable turnover. So when we were talking about turnover, it isn't just turnover, just any turnover, just any kind of money that you've taken in. It's taxable turnover. So what forms taxable turnover for the purposes of VAT? So you've got to consider whenever you're looking at VAT that there are different rates of VAT, and there are things that are out of scope for VAT as well as things that are zero rated for VAT. And it can get quite complicated. So what is not included in the value of everything that you sell when you're considering whether or not your turnover has breached that threshold, then we're looking for things that are not exempt from VAT and they're not out of scope for VAT. So things that we wouldn't include would be, and I'm going to talk about exempt things in a moment, but if you were providing childcare, so childcare nurseries, it's exempt from VAT, and there are other things, we'll talk about them in a moment. But things that are included are zero rated goods. So some things you don't charge VAT on them, but there is VAT on them, but at a rate of zero. Remember right at the beginning, I said that this was the most complicated tax that we have to deal with. So there is a time when you would not be charging VAT, but you would be charging VAT at a rate of 0. There wouldn't be an amount, but it would be rated 0. And I'll talk about what some of those things might be later. Reduced rate goods, standard rated goods at 20%, so reduced rate is 5%, goods that you hire or loan to customers, business goods used for personal reasons, goods that you bartered or part exchanged. So if you're doing, let's say you're creating a website for somebody and in return, they're going to decorate your office, right? So if that's a barter and both of those things are £3,000, you're allowed to do that, but you've got to reflect the value of the sale of both of those transactions in your accounts. That's the way that works. You may not actually pay any cash, but you've got to reflect the transactions in your accounts and you've got to reflect them for the purposes of whether or not you've breached the threshold for VAT, as well as other reasons. So services that you receive from businesses in other countries, but were subject to a reverse charge, they would be included, and goods and services that are subject to domestic reverse charge. So we'll talk about some of these things later, but all of these things on this list are included in the things that you're potentially selling and would fall into your taxable turnover. So I just also at this point want to mention what happens if you're late registering. So we talked about if your turnover therefore breaches that 90,000, either in the next 30 days because you do big contracts, or it's gradually crept up on you because you're running a cafe and you're just really busy and you hadn't realised and you breached the threshold previously. And now you realise that you have. Well, the first thing is that you need to register, but you need to register from the date of effective registration, and that might be a date in the past. And when you have to register for a date in the past, there's a few implications. One, wherever you invoiced during that period of time from the date of effective registration is assumed to include VAT. So you may not have added an amount to it because you were VAT registered, but it's assumed that you were. So if you took £1,000, then that £1,000 is assumed to be £833.33 plus VAT. And the VAT amount needs to be paid over to HMRC. So there can be quite a big VAT bill associated if you don't register to the right timescale. So please do monitor that and make sure that you don't end up in that situation, because also you may need to pay a penalty depending on how late your registration is and how much you owe. HMRC may impose a penalty on you, as well as having to pay all that VAT. You may have to pay a penalty as well. So please do monitor your taxable turnover. So within VAT rules, we've got 0 rated and we've got exempt. So 0 rated are items that you are charging VAT on, but you're charging them a rate of 0. And exempt are things that there is no VAT on at all. They're exempt from VAT. It's really important to understand the difference between these two things, because if all of your supplies are exempt from VAT, then you can't register for VAT. So you're not going to be charging anyone VAT because all of your supplies are exempt. It means that you cannot recover the costs that you incur that include VAT. So for some people in education settings, in childcare settings, in lots of other settings, they can't charge VAT because they're exempt from VAT, but equally they can't reclaim the VAT on any of the things that they need to buy to provide their services that may have VAT on them. If, however, what you're selling is 0 rated, so kids' clothes, let's say, if you had any purchases that you'd made that included VAT, then you're absolutely fine. You can register for VAT and you can recover that. There is a something. If you've got some exempt supplies and some not exempt supplies, that you can do a partial exemption. You have to apply for it. De minimis rules apply. It's really, really complicated. And I would definitely suggest that you need advice if you think that's you. So bear that in mind if you think some of the things that you're selling are exempt from VAT and some of the things that you're selling are not. So bear in mind this really, really complex system that we've got called value added tax. Why would anyone ever voluntarily register? Well, the reason people voluntarily register is to reclaim the VAT on the goods and services that their business purchases. If all of your sales that you make are to businesses, and if all of those businesses, or the vast majority of those businesses, are VAT registered, they won't care if you're VAT registered or not, if you're charging VAT to them or not, because they'll reclaim it on their own VAT return. So if all of your customers are business customers who are VAT registered, then arguably you should voluntarily register, because it allows you then to reclaim the VAT on the goods and services that your business purchases. So something to definitely consider. Another thing to consider within this and voluntary registration for VAT is change causes complexity. So if our business is dealing with businesses who are VAT registered, and that we always expect to breach the VAT threshold and charge VAT at some point, in a lot of ways, it's easier to just set up right from the start being VAT registered, so that you don't have to make changes to your processes and procedures, so that you don't have to make changes to the invoices that your clients see, so that you don't have to change any of the things that you do as you get busier further down the line. So if people are not going to be deterred by the fact that you're charging them VAT, then maybe you should. For that reason, for the fact that you don't have to make a change later on, register for VAT voluntarily. And a last reason I'm just going to mention, and I've mentioned this in one of my other webinars as well, is I have this thing called my 5 badges of professionalism. And the first badge of professionalism is, the reason I have my 5 badges of professionalism is because people judge us. People judge us on all sorts of different things, and business people are no different. So business people will judge other businesses based on a criteria that they've decided for themselves makes good business sense. And one of those things can be whether or not somebody's a limited company. And another one is whether or not somebody's VAT registered. And then on that list, I've also got having a website, landline telephone number, and an email address that isn't Yahoo or Gmail. It's actually your business name. So, but focusing on the VAT one, why would registering for VAT be on my 5 badges of professionalism? It's because people make assumptions. And the first time they buy from you, they buy based on assumption. And if you're registered for VAT, their assumption is that your turnover is more than £90,000 a year. So if you're registered for VAT, they're making an assumption as to how good you are at what you do, how successful you are in your business. This might be week 3 of trading. This might be the first invoice you're raising. But if it's got a VAT registration number on it, they're making an assumption with absolutely no knowledge to dispute that or agree that it's true, that your turnover is more than £90,000. So it is possible that you want to register for VAT to make your business look more established, more successful, more profitable, more whatever, has a turnover of more than £90,000. Because at the end of the day, it's not to do with anybody else what your turnover is, and they're making that assumption for themselves. And it might just mean that you win business that you wouldn't have won if you weren't registered for VAT. I know it sounds bizarre, but it can be true. So you've breached the threshold, you're about to breach the threshold, or you've decided that you want to register for VAT voluntarily. What do you do? So how to for VAT? I've forgotten the word register. Anyway, how to register for VAT. So you go online, go onto HMRC, go onto your online taxes portal. If you don't already have one, you can register for one of those and get your gateway password ID and go into the VAT area of the online taxes portal and register for VAT. That's what you do. It's all on there. It's all online. It's a relatively easy process to follow. You will be asked for a few details. So bear in mind, you're going to be asked for your company's registration number or your UTR if you're a sole trader, because sole traders can be registered for VAT too. You're going to be asked for your business bank account details, your company's UTR, unique tax reference number. So the company registration is the company's house one, the UTR is the tax one, and details of your annual turnover. So what kinds of supplies are you making? How much is that going to look like? It's a guess. They're not going to hold you to it. So if you said, I'm going to do turnover of 500,000, nobody's going to come knocking on your door if that's 1 million or if it's 350 pence. It doesn't, it's just a thing that they're going to use in their metrics. But they're trying to work out whether or not you're going to breach the threshold or whether you're doing this voluntarily. Doesn't actually make a huge amount of difference, but they're going to ask you it anyway. What happens then is you'll put all the information that they ask for. They'll probably ask for your SIC code. So the thing, if you did register your company on Companies House as a limited company, that's the thing that says what it is that you do. So they'll ask for that because they want an idea of what you do. And the real reason they want an idea of what you do is because they want to know whether you're going to be selling VATable supplies. So they'll want that and some other questions. And those other questions that they ask you will depend on how you answer some of the other questions. So I can't really go into the details of every single question they're likely to ask, but they all should be relevant to you. So it's you, it's your business. You should be able to answer those questions without any difficulty. Once you fill in all the details, they'll say, no worries, we'll come back to you with the VAT registration number. And they will. It takes a little bit of time. At the moment, to get a VAT registration number out of HMRC is taking over a month. So if you want a VAT registration number to put on a sales invoice, you need to give yourself a good bit of time before you're going to have that to put on that sales invoice. It will come through the post. So watch the post. It will come through to your registered office address. You can check on your online taxes portal in advance of that. So if you're anxiously awaiting your VAT registration number and nothing's arrived in the post, and we know how slow the post can be sometimes, check online through your online taxes portal, and you might actually find that it has been issued and it's sitting there. So then once you've got it, you can then set it up in your system that you've got for raising your invoices and follow those processes. So, but it does take a little bit of time. So on the registration, when you get it, you'll get that 9-digit number, and you need to be declaring that 9-digit number on every sales invoice that you raise from that point in. You'll also get information about when to submit your first VAT return and when to pay it. Most people, we'll talk about some of the schemes in a minute, but most people will be on a quarterly scheme. And the quarterly scheme will be issued to you by HMRC. So they'll tell you when that quarter will end. Sometimes a quarter isn't 3 months. Just a little watch out there. Sometimes a quarter can be 2 months. Sometimes it can be 4. It's only that first one that will do that. but they will tell you the date that they want you to do the first reporting period up to, and also the date that the payment and the VAT return will need to be submitted. So that'll all be on there. If that quarter that you get, assuming that you've gone quarterly, isn't coterminous with your year end. So what do I mean by that? Let's say your year end is the end of March and HMRC issues you with a VAT quarter that ends at the end of February. You don't want that. And you don't want it to be the end of April either. You want it to be in line with your year end. If it isn't, you can request for it to be changed so that it does fall into line with your year end. So do that, and you'll also get the confirmation of the date of registration. So based on the information that you gave HMRC when you did the registration, you will get that effective date of registration, and that also will be on that document or on your online taxes portal. So you'll need all of those things. So the confirmation of the effective date of registration will need to go into your bookkeeping software. And you'll need then to account for the VAT from that date on. But what if you were having an effective date of registration that was the 1st of April, and that's lovely, and you've put it into your software and it hasn't happened yet, and you're going to be able to raise your invoices with the VAT number on from the 1st of next month, brilliant, but you've already been trading, and you've already made some purchases. You've bought things to start the business, you've bought things to use in the business, you've bought goods, you've bought services. Can you reclaim the VAT on any of those things from dates when the dates on those were before the date of registration that you get on that document that you get from HMRC? Yes. In some cases, rules apply. The first thing I would say is, keep receipts, keep receipts, keep receipts, keep receipts for everything. So normal accounting practice, normal good accounting practice requires you to keep receipts for everything that you spend in your business. And it is even more important for VAT. You cannot, in any circumstances, recover the VAT on something that you've purchased if you don't have a VAT receipt. The amount you can recover is the amount on that VAT receipt. So I really can't be any clearer here. You must keep receipts, and it must be a VAT receipt, not a credit card receipt. Other parts of the tax system will allow you to use supplementary evidence, and that supplementary evidence can be a bank statement, it could be a credit card statement, it could be a credit card receipt, not for VAT. So make sure that you've got those receipts. So what can we reclaim? So a piece of work's required now. So we've registered for VAT, we've already been trading, or we might not have already been trading, but we've already been spending. We need to go through all of those things that we've spent prior to registration and check whether we can recover the VAT, because we need to recover them on that first VAT return. So if we've had any services, so things like accountancy service, there might have been legal services. If you've got services, then it's just the 6 months prior to registration. And this, if you've had big costs associated with services to start up your business, might be the reason that you voluntarily register before your turnover breaches the threshold, because you want the ability to recover the VAT on that big legal bill that you got right at the beginning. So 6 months of registration for services. And goods, it's 4 years is the date of purchase. So that could be a laptop or a phone or something like that. But the reason why it says goods must remain on hand at the date of registration is because this also includes things that we buy to sell. So tins of beans, we're buying tins of beans and we sell tins of beans. We can recover the VAT on the tins of beans as long as they're still there and not yet sold as at the date of registration. So stock of goods that we sell, we can recover the VAT on those, not the things that we already sold prior to registration. So how do we do that? We get together all of those items, we create a list of all of those items, we make sure we've got receipts for them all on hand, ready for HMRC should they ever want to have a look at your list. And then we process through our software a journal, which is a bit of an accounting thing, but a journal that says these were the goods, these were the services, and this was the VAT on them. And the journal will push the VAT entries into that first VAT return. And sometimes that first VAT return can be a VAT recovery situation. Sometimes HMRC are giving you money on that first VAT return. There are occasions when you get VAT back in other circumstances, but the first VAT return is a relatively common one. So VAT schemes. So when you register, you will be defaulted to the standard accrual scheme unless you ask for something else. So the standard scheme is known as the accrual scheme. And what does that mean? The standard accrual scheme for VAT takes the dates on the invoices that you raise and the dates on the receipts for the things that you purchase. So everything that we do has a date on it. It has to have a date on it. It's a legal requirement. So the date on the receipt for the phone that you bought or the laptop that you bought or the date on from your invoice from your accountancy provider, whatever it is, the date on that is the date for the VAT quarter and the date that you raised the invoice to your customers. They're the dates. And in this little example here, we've just said that sales in the period with dates within that quarter were 10,000 plus VAT, £12,000 gross. Purchases that we made for things that had VAT on were £2,000 plus the VAT, £2,400. The difference between those two amounts for the VAT column is £1,600. And that is the amount in this example that you would pay over to HMRC. And you pay it over by the 7th of the month following your quarter end date. So if your quarter ended March, you wouldn't have to file during April, but you could, but you'd have to file by the 7th of May and also pay the VAT by that date. So there is another quarterly system that is also really, really popular and pretty common, and that is the cash version of that. If you have got a business whereby some of your customers or sometimes your customers take longer than 5 weeks to pay you from the date that you raise the invoice, you could, under the first system, end up having to pay VAT on sales that you hadn't yet been paid for. Now, that is a painful place to be from cash flow. So the cash VAT system, instead of taking the dates on the invoices you raise and the dates on the receipts for the purchases that you make, now it looks at the bank account. So it looks at your business bank account and the dates that it takes is the date that the money went in and the date that the money went out. And it was the date, therefore, that the sales receipts were in the period. So the dates that your customers paid you and the dates that you paid for the supplies that you needed in your business. So the numbers can still be the same, but the timing is likely to be different if you've gone down the cash VAT route. But if everything that you sold was paid on the day you sold it and everything that you purchased, you paid for on the day you purchased it, it would be exactly the same. But this cash VAT scheme can take into account that timing that you have between raising a sales invoice and being paid for it. And that can be crucial from a cash flow perspective. It's a relatively simple thing to change. You don't even need to let HMRC know you're doing it. And most bookkeeping software now gives you the option of changing from accrual to VAT with the click of one button. One button. So you can move from one to the other. I wouldn't suggest that this is something that you consider doing on a regular basis. But if your business is one where sometimes getting paid can take a while, the cash VAT scheme might be one for you to consider. Another VAT scheme that's quite popular with small businesses is the flat rate scheme. And the flat rate scheme was set up to reduce admin, to make it an easier thing for small businesses to do when they're doing their VAT, when they're processing their transactions in their business. Now, I don't buy into that. I don't believe that it's true. Because regardless of which VAT scheme you are in, you need to process all of your sales invoices, including the correct VAT rate and amount and your VAT number and all the rest of it. It doesn't matter which scheme you're on, you're going to be doing exactly the same with your sales invoices. And regardless of whether you're on the flat rate scheme or not, you're going to have to process all your purchase invoices and the VAT on them. Because if you're on the flat rate scheme and you make a profit out of the VAT man by being on the flat rate scheme, and you can, and I'll talk to you in a minute about how, then you have to pay corporation tax on the difference on the profit that you made because you chose the VAT scheme. And the only reason you can work out that profit is because you've processed all the purchase receipts correctly with their relative VAT amount on. So it doesn't save any admin at all. That's rubbish. But what it can do is save you money. So it's worth considering. If your turnover is going to be less than £150,000 in the next 12 months or less, excluding VAT, you can join the scheme. So this is only for small businesses. If you join the flat rate scheme and then your turnover goes over £230,000, including VAT, you must leave the scheme. When you're in the scheme, the way that it works is it takes your sales. So let's say your sales are £10,000. So we know that we have £10,000 of sales. Standard rate of VAT is 20%. We're going to invoice our customer £12,000 because we have to charge them VAT at the correct presiding rate. And the flat rate scheme doesn't change that. We would still, on our sales invoices, charge VAT as normal. We then take that gross number, so the £12,000, and we multiply that by whatever our flat rate is. Our flat rate is on a list on HMRC's website. And the list doesn't include all business types. You have to find the one that is closest matched to you. So you find then the flat rate that you're going to use and you multiply the gross sales by that, and that is how much you pay HMRC at the end of that quarter. Regardless of how much you spent, regardless of how much you spent on items that would have VAT on them. Unless you made capital purchases with a single invoice of more than £2,000, in which case you can recover the VAT on that, even under the flat rate scheme. And the first year that you're registered for VAT, if you join the flat rate scheme, they give you a 1% discount. So if your rate was 14.5%, because you don't have a lot of taxable purchases, it's mostly time that you sell, and it's 14.5%, that's your rate, then actually you reduce it to 13.5% for that first year, but you must remember to increase it in the second year. But that first year then, you could make 1%, and 1%'s a lot. So it's worth looking at. It's worth checking the shape of your business, if your turnover is going to be under 150,000, and seeing if you would be better off pay over less VAT under one of the standard schemes, or whether you would pay less under the flat rate scheme. Definitely worth looking at. So there is an annual accounting scheme. Hurrah, we say. We only have to do one VAT return. Well, that sounds like a bonus. Let's do that. Let's just do one VAT return per year. So how does that work? So you do your one VAT return at the end of your VAT year, of your tax year. But the first year, you would have had to estimate what you thought that was going to look like. And then each month during the year, either based on the estimate or based on last year, depending on where you are in your business journey and your VAT journey, then you have to pay monthly towards that bill. So you're still going to be paying the VAT during the year, but you're paying it monthly towards that bill. And then at the end of the year, you do a giant VAT return that covers the whole year. And that might mean that there's a bit of an additional payment to be made or a bit of an additional refund when that's submitted. And then that's the number set that would be used for the next 12-month period. So why am I not as keen on the annual accounting system? Because it doesn't encourage you to do your bookkeeping regularly. And if we have to now find VAT receipts for a whole year's worth of things that we bought, there is a good chance that we're going to have lost them. And I would much rather you get into a system whereby you're processing those things regularly. And I know, because we've got a few clients, this is not our first rodeo, that people generally are busy and they're not wanting to do the bookkeeping. They're not wanting to prioritise doing the bookkeeping. They want to prioritise growing the business, not doing their bookkeeping. And if they're doing therefore their own bookkeeping, it can get left behind. And if it's getting left behind a quarter, you have much more chance of finding those receipts than if it gets left behind for a year. So just bear that in mind. And you can ask to join the scheme when you register, or you can ask to join this scheme later using a form VAT 600. And you can only do it if your turnover is less than 1.35 million. So what about then doing monthly returns? Madness, you say. We've been talking about this wonderful idea of just doing one VAT return a year that Joe's trying to put us off the idea of. I think it's a great idea. Why would anybody do monthly returns? Well, some people actually like to pay monthly because they don't want that VAT sitting in their bank account looking like it's money they can spend, only to find at the end of the quarter that they've got a big VAT bill to find and they've spent the money. So some people prefer to pay it monthly. Just so you know, if you are on quarterly VAT, it is a really good idea to have a separate bank account that you hold your VAT in. But it's also possible, if you wanted to make payments on account towards your VAT even before you've submitted the return. So if that is you and you're anxious about having that money in your bank account, pay it over to HMRC if you like. That's absolutely fine. They will take your money off you any day of the week. Don't you worry about that. So monthly returns, goes without saying that you're going to have to submit it every month and you're going to have to pay or reclaim every month. And the reason I say pay or reclaim every month here is because people who go on monthly returns, who don't have to go on monthly returns, and some people do have to go on monthly returns, but they're large businesses with a VAT liability in a year of more than 2.3 million, which is quite a big VAT liability, let's face it. So for most people, it would be a choice. And the people who are making that choice typically are people who are caught under the CIS VAT, the reverse charge, I'll get my words out in a minute, the reverse charge for CIS. So what that means is they don't get to charge VAT on some of their invoices, but they are paying VAT on all the goods that they're buying to install in somebody's house or business or whatever that might mean. So they want to get the VAT back on those purchases as quickly as possible. And they're always in a reclaim situation. Therefore, there's been a groundswell of movement of those people caught under the CIS scheme of moving to monthly, just again for cash flow. So if you want to do monthly returns, you can send a VAT 484 off in the post to join. You have to stay for a minimum of a year. So if you think, see how it goes, I'll go with the monthly, we don't like it, you're going to have to stay for a year. So if you're going to do it, you're in it for a year. There are other schemes, and a lot of the other schemes are based on retail businesses and those selling second-hand goods, but there are also specific schemes set up for really niche specific kinds of businesses. So the VAT scheme for tour operators, the TOMS scheme as it's known, is literally just for tour operators. So they're buying and selling rooms or holidays or whatever. There is a scheme that is just for them that you can only join if you do fall within that area. And I would suggest you wouldn't want to join it if you weren't somebody who did that, because it's awful to manage. Anyway, you've also got schemes like the margin scheme. So if you think, what is the margin? The margin is the difference between what you sell something for and what you bought it for. That's the margin. So the margin scheme, there's point of sales scheme for retail businesses. There's apportionment schemes. There's direct calculation schemes. I mean, we've got people who we represent who have to do some apportionment calculations because they don't have point of sale devices that collect all the information that they would need for VAT. So if that is the case, there could be a scheme that you could use and a calculation method that you could use in your business. You don't necessarily have to invest in what can be a very expensive point of sale device because you've breached the VAT threshold. So worth looking if that is you at one of those specific schemes. So who can't join a scheme? So if you've registered for VAT and you're fancying the look of monthly or annually or the flat rate scheme or something, you can't join a scheme if you left it in the last 12 months. If you've committed a VAT offence in the last 12 months, what is a VAT offence? Not filing on time, not paying on time, something along those lines. That's what they're talking about. You were in a VAT group, stuff like that. So just watch out for those things. Or if you've already joined another scheme, you can't be flitting back and forth to different schemes. And just while I'm on this slide, I'm just going to mention about VAT, artificial separation for VAT. So I've not put a slide in on it, but I will just mention it here. So it's talking in here about your business is closely associated to another business. And what it's talking about is artificial separation. So if you've got, I've been asked this question specifically a few years ago now, but I've got a hairdressers and I also sell product. So if I have two businesses, one for the buying and selling of hair product and one for doing hair, and I will charge VAT on the one where I'm buying and selling product, but I won't charge it on doing people's hair because basically I'm selling time on that one. That is most likely to be artificial separation because those two businesses are run out of the same premises by the same people who are doing really the same activity. And the only reason they created two businesses was to avoid registering one of them for VAT. So you really need to be careful if you've got more than one business as to whether or not they're all registered for VAT. You might have to register them all for VAT if they are too closely associated with each other. So definitely get advice on that if you're not sure. It is quite a complicated area. So direct debit, when you sign up to register for VAT, you'll be asked if you want to sign up for direct debit. And I would recommend that you do. And the reason why I recommend you do is twofold. Number one, people forget to pay their VAT. They get really busy. And even though it's the same day every quarter, and even though you might have an accountant who sent you an email who said, we've submitted your VAT, and on you go, oh yeah, I'll pay that. I'll pay that when I get a minute. And then you forget. And then suddenly you're getting penalty points because you've forgotten to pay your VAT. If you register for direct debit, it will automatically call the money on the seventh day. But because it's called it on the seventh day, it won't take it for 3 more working days under the direct debit scheme. Therefore, you'll get an extra 3 days to pay. And actually, that's 3 working days. So it could end up with being 5 days, extra 5 days to pay. So you get an extra bit of time to pay if you sign up for direct debit, and it means that you don't have to worry about forgetting. Now, some people don't sign up for direct debit because cash flow is just so tight that they can't have that automatically drawing their cash on that day. They might not have the money in the bank on that day. But if you can, I would suggest do. So imagine you've been registered for VAT and business falls off. You know, you're not trading as much, you go part-time, you semi-retire, whatever it is, and you've been registered for VAT, but you're no longer breaching the threshold. Then if you're no longer making any VATable supplies, any taxable supplies, then you must deregister for VAT. And also if you join a VAT group, now you're in the VAT group, you're not having your own VAT registration separately. And you must cancel it within 30 days or you could be charged a penalty. But also you can choose to deregister for VAT. If your turnover falls below 88,000, you can ask HMRC to cancel your registration. And people do that. You know, they do go part-time, they do semi-retire, they do, you know, the shape of their business changes for whatever reason and they want to come out of the VAT system. So you can do that. You just have to apply to HMRC to do it. So VAT rules. So we've registered for VAT, what must we now do? So we must charge VAT on absolutely everything we sell once we're registered, and at the rate that those goods or services should be sold at. And you must display that rate on your sales invoices and also your registration number. So that's the first thing. So you need to change your sales invoices, your point of sale system, whatever it is, to include the relevant sales VAT items. So for purchasers, you must have receipts for all expenses where you're looking to reclaim the VAT. And when you're putting it in your software, the VAT amount has to be the same as on the receipt, even if it's wrong. So if you've got a receipt and they've charged you wrong, you need to put it in your software as that amount because that's the receipt that you're using to support your claim. So unless you can get that reissued with the correct rate, if they've issued it wrong, that's what you need to put in. If there's been a rounding that your software's done that's different to the rounding that the software they've used has done, then you need to change it often by a penny, but it should be exactly the same. And it should be a valid VAT receipt, and that has a VAT number on it. That has to have a VAT number on it. It doesn't always detail out the amount of VAT, but there will be something on there that identifies which items are VATable typically. So if it's at Tesco, they might have a 1 or a star at the side of the ones that have got VAT on. But if you're not sure, then Google will give you the answer on whether or not something typically is VATable. If you don't have a valid VAT receipt, even if the thing you bought had VAT on it, you cannot recover the VAT and you need to process it as if it was 0 rated. So choose 0 rated for the VAT rate. If at some point in time then you find that receipt, you can go back into the software and amend it to standard rated or whatever it was, and it will appear on your next VAT return. You're allowed to do that. So you must keep your records for 6 years plus the one that you're in case ever you get an inquiry. You must account for VAT on any goods you import into the UK because we apply VAT at the border. on those things, but you will be given documentation associated with that import. So use that. You must file your VAT returns once you're registered. Even if there's nothing on them, you have to do nil returns. So deregister if you're not going to be doing any more trading, or file them either quarterly, monthly, or annually. If you charge more VAT than you pay out, then you pay the difference over to HMRC. And if it's the other way around, they pay you. A lot of the time, they're going to ask for more information before they pay any money to you. So be aware of that. And you can appoint an agent to deal with HMRC on your behalf for VAT if that is what you want to do. So just some examples then. So what is a standard rated supply? It's the default, so pretty much everything. So most of the things, if the default rule is expect it to be 20% unless you're told otherwise, then that's the standard rule. So most things are standard rated. But some things are zero rated. So this was, remember, when things are still VATable, but they're VATable at a rate of 0. So these things on here, VATable at a rate of 0. Interestingly, when we bought a defibrillator to go in a box on the outside of our office, because we didn't want anyone to die when we told them how much their tax bill was, you know, that kind of thing, going to some kind of respiratory arrest. So we decided it was a good thing. My other half actually is in the fire service, so that was the reason he scared me, and I got one. You pay VAT on a defibrillator. Can you believe? The VAT system is not perfect in any way. So that didn't matter to me because I'm VAT registered, I could recover it. But if you're a charity, you know, lots of charities and associations do collections for defibrillators, don't they, for the local community? And you're having to shell out that and you've got no way of recovering it. It's wrong. It's wrong. Anyway, so these are the kinds of things that are zero rated. There are exceptions, though, to the zero rated rule. So food and drink for human consumption is usually zero rated, but it's so complicated. So if you've got a cafe, a restaurant, a shop, you really need to think about whether or not the food that you're supplying is in the purpose of catering, whether it's alcoholic, whether it's confectionery, whether it's crisps or snacks, whether it's, you know, so the reason why the giant marshmallow is in the appeal courts at the moment is because, is it an ingredient or is it confectionery? And would you believe Pringles went to the appeal court because they argued that Pringles are not crisps because they're not made of whatever, they're something else. What were the cakes? I think they wanted the cakes. Pringles are cakes. Yeah, right, whatever. So people argue all sorts of weird things. And there is the biscuit versus cake rule. And biscuits go soft when they're stale and cakes go hard. Honestly, that is a rule within VAT. But the most prevalent thing that you might have heard of within this whole mess of an area around whether or not food is charged for VAT or not is hot or cold or incidentally hot. So it was known as the pasty tax when it first came out, and a politician was buying a pasty on a railway station. And that was the example that they used. So if you go into Greggs and you sit in and eat your sausage roll, you'll be charged VAT on it because you're sitting in. If you take it away, you're not going to pay VAT on that sausage roll, even if the sausage roll was hot. And the reason why it doesn't fall under hot takeaways rules is because Greggs bake on site. They don't provide packaging that keeps it hot, and they don't say it's hot food. It's just food. So if it is hot, it's incidentally hot. And if you take it away, therefore you don't pay VAT on it. But if you get from them a bacon sandwich, you're going to pay VAT on it because a bacon sandwich will always be hot. And if you get one of their paninis out of the cabinet that they then put in their, in their oven and warm up to melt your cheese, you'll pay VAT on that, whether you sit in or take away. So there's some really complex VAT rules associated with food, and things like ice cream is another one. It's something that's meant to be eaten frozen, and that then falls kind of under the same rule. So it isn't zero rated because it's meant to be eaten frozen, and you eat it frozen, and therefore you get charged VAT on it. So complex area, please do check if this is you, that you are putting into your point of sale device. If you're offering takeaway versus eat-in, that's the first thing that you need to be doing, that as an option, and then what kind of food that is. And it is really complex, especially for people running cafes and restaurants and shops, where they're often having a high labour turnover and often employing young people who might not understand the point of sale or the implications of clicking the wrong button. But that is the rule, unfortunately. So exempt supplies. So we talked about exempt supplies earlier. If you're making exempt supplies, you can't register for VAT. So what falls under that? So nursing homes and hospitals and dentists and educational training provided by an eligible body. Be really careful with that one, because it has to be by an eligible body, and most of the time that means it needs to be part of the curriculum. So if you're providing business training to businesses, you're going to be standard rated on that. So watch out for stuff like that. Complicated rules with complicated sub-rules. And then reduced supplies, so things like utilities, they're on a reduced 5% rate, and some other things are also within there, so mobility aids for the elderly, and disability things generally are either zero or reduced rate, and energy saving are reduced rate. Out of scope. So when you're doing your bookkeeping and you're thinking about things that you're spending in your business and whether or not to choose 0 or 20% or exempt or whatever, there is something within VAT called out of scope. So it will ask you if you're VAT registered every time you process a transaction to choose the VAT rate. But some things fall out of scope for VAT, like payroll. So your payroll doesn't appear on your VAT return. That's what out of scope means. It's not going to appear anywhere on your VAT return. Exempt supplies do. Zero rated supplies do. Out of scope supplies don't. They shouldn't be there. So payroll shouldn't be there. So if you're processing transactions for payroll, click out of scope or no VAT. It is in QuickBooks. It's got various terminology in different softwares. And things like when you're paying your VAT bill, that'll be out of scope for VAT. It sounds obvious, but we've seen people click it. They've put VAT on the payment that they made to the VAT man, and the same for any other taxes as well. So just a quick mention of CIS reverse charge, because it is really complicated and it only came in a relatively short period of time ago in the last few years. Basically, if people are providing services or receiving services under the CIS scheme, which is the construction industry scheme, then they must follow this new set of rules. And the new set of rules largely says the people who you want to charge VAT to, you can't, and the people who you don't want to charge VAT to, you have to. So if you're doing a boiler for Mrs. Miggins on Brigshaw Drive, then she's not VAT registered and she's not in the CIS scheme, and she is an end user of the stuff, so you have to charge her VAT. But if you're doing it for a big development or whatever, and that person is VAT registered and falls under the CIS scheme and all the rest of it, you can't charge them VAT. And now you have to pay for the boiler with the VAT on it, but you can't charge on the VAT to anybody. And these are the people who've gone monthly because they want their VAT back. They also have to make a decision about whether to charge VAT or not. So your plumber, your plasterer, your brickie, they're having to make decisions on whether or not they charge VAT on the things that they do. It's tough. for those people to make those decisions sometimes. You know, the rules are not that clear. So you use this rule, and if you're not charging VAT, you also have to put a statement on your invoice, and the statement advises your customer or the contractor, main contractor on the job, that you've used reverse charge rules and that you're not putting VAT on your sales invoice, and therefore they need to account for the VAT. And the reason HMRC brought this in was because a lot of builders were going under, and they were going under having recovered VAT, and HMRC wanted to cut them out of the chain. So it's a complicated rule, and if you're not sure about it and you want to know more about this, please ask for some one-to-one time or speak to your accountant, because it is complicated. Another really complicated thing is place of supply. So if the place of supply is in the UK or deemed to be in the UK, then normal VAT rules apply. If the place of supply is outside the UK, then no UK VAT is chargeable. But where is the place of supply? And there are different rules for businesses than there are to individuals. And one example of this that I had a look at fairly recently was somebody who was doing something like this. So something like this, I'm in the UK and I'm delivering this live in the UK. So my place of supply is the UK. But when the recording of this gets laid down and people can download that recording, if that person was paying for that downloaded recording and they weren't in the UK, the place of supply is no longer in the UK because it's a recording. Yeah, it's really, really complicated. So again, if you're not sure, please do ask, because it is a very, very complex area within the legislation. So what is the tax point? So we talked about raising sales invoices and receiving receipts with dates on, and that would be our date that we use for the VAT quarter or month or year, unless we were on cash, in which case it'd be the date that was paid. But there's another rule that you need to be aware of. So the tax point for VAT is either the date on the invoice or when the payment was made. So if somebody pays you first and then you raise an invoice, the VAT date is the date that you got the money, even if you're not on a cash scheme. If the date paid comes before the date on the invoice, you have to take that as the tax point. Another little complicated, interesting nuance of the VAT system. And then just finally for today, I just wanted to mention Making Tax Digital for VAT. So Making Tax Digital has been around now for a few years for VAT. The soft landing came in. We did all sorts of bridging and all that kind of thing. But fundamentally, it's in. Everybody who is VAT registered has to comply with it. And what does it mean? It means you must keep digital records and that you must file digital returns. If you've got bookkeeping software, then that bookkeeping software should allow you to make your digital returns through that software. And digital records mean that you can't be adding stuff up on a calculator and putting the number into your software. We used to have people who had shops, for example, who rather than processing sales daily through their bookkeeping software, they would process monthly through their bookkeeping software. And you can't do that anymore. There is an allowable thing for people who've got shops who wouldn't necessarily know the name and give a named receipt to every single person who came in. You can do daily sales. Daily sales. So you would need to get from your Z reading, from your reports, from your point of sale back end, the daily numbers, and put those into your bookkeeping software and then file those returns digitally. So that's what Making Tax Digital means. And if you've got software, then it shouldn't be an issue to you. Don't forget that one-to-one support is available, and you just need to email Joseph and ask him for the one-to-one support if that's something that you want, and we can talk about these complicated areas of VAT. If you're not sure whether you want to register for VAT or that kind of thing, you can have an hour or up to 2 hours of my time, and Joseph's got some paid one-to-one support already laid down. We've got one final webinar in this series, and it is employing people, and that is next Tuesday, the 1st of April, into April already, and talking about how you set up a payroll and all the ins and outs of what you need to be aware of when you do, in fact, employ people. So please register for that one if you think that might be useful to you. And then that just leads me to hand it over if you've got any questions.
Thanks for that, Joe. Yeah, as always, so much to take in. And I'm weirdly having fond memories of running off the Z report when I worked in a shop at the end of the day, because you've reminded me of that daily exercise that I have to do. Yeah, thank you for that. As you've mentioned, we have got those one-to-one slot, and you've done 2 batches of these. And for the first batch, people were really biting our hands off to get the time.
Yeah.
And less so on these ones. So you're either doing
Yeah.
things absolutely comprehensively and there are 0 questions.
Must be it. No
or
questions?
We've got a shy audience, but there are slots available. So even if you're only sort of half-minded to be interested, the slots are available, and I've paid Joe already. So please do take us up on that. I'll just stop the recording there, but I wanted to include that bit on the recording, because even if you at home are watching on a recording now, get in touch with me. I would love to give Joe's time away because I paid for it. Okay, right, I'll stop the recording.